Hello and welcome back to another Hargreaves Lansdown portfolio update video where I basically take you through my Hargreaves Lansdown stocks and shares ISA portfolio. It's got 6 funds in there at the moment, 6 different mutual funds, all covering different areas of the stock market. So yeah, it's been a bit of an interesting one. The market has been on a bit of a tear recently. It's carried on since April. There was a big crash because of Trump and his tariff announcements. But since then, it's been one direction, and I'm now getting screenshots from my friends on their profits, which is normally a dangerous sign. You've got a lot of optimism, a lot of froth in markets. I think you'll have seen, if you're interested in markets, you'd have seen Sydney Sweeney's recent advert for a company called American Eagles, which sent the stock up like 6% or something. Oh, I think it was like 25% or something in a day. So there's clearly some excitement around stocks, which we're going to talk through performance and pretty much just go from there. Before we get into it, just need to remind everyone that this is not financial advice. This video is for education and entertainment purposes only. So yeah, with that covered off, we'll come on to the Excel dashboard where I can talk about my portfolio. Right, here we are, portfolio dashboard, starting at the bottom like usual. Haven't been able to contribute since the 7th, so that's when I get paid, first week of every month. So we're going to be waiting a couple of weeks till I can add to this portfolio again. Let's scroll up quickly. At a high level, you can see that we've made another couple of 120, let's call it, £115 since last time. So again, markets are on the upward trajectory. The charts on the right are sort of biased because, especially this one, because it takes into account the contributions that I've made. So that 3 and a bit grand, yeah, 3,100 since the 10,000 lump sum has helped the performance, let's put it that way. But yeah, that's where we're at. A little bit of gain since last time, the last 10 days or so. This portfolio is quite different to the broader equity market, so it's definitely underweight the sort of tech growth, meme sort of narrative that you get. So if you're in a NASDAQ tracker, for example, which is more tech, that would definitely outperform this portfolio in that sort of market. Come to the top, just to talk through that in a bit more detail. These are the 6 funds that I'm invested in. And really what I was trying to do with this, let's get rid of that because that's from the last one. That's old news. No buys or sells this month, this episode, because like I said, I hadn't had any more contribution since last time. But yeah, there's 3 funds that are more aggressive and 3 funds that are more defensive. So in the defensive sector or area of the portfolio, we've got Global Insurance, we've got Fidelity Special Situations, which is a UK equity portfolio, and then we've got Health and Pharma. So all of those are supposed to be sort of steady eddy, strong cash flow generators that are pretty boring. And that's what you've seen when we come onto the charts in a bit. You'll see that that's been the case. And then the other 3 are far more aggressive. So again, say I had a portfolio of just these 3 since the April bottom following the tariffs, that would have smashed the rest. But that's not really what I like to do with my investments. I prefer to have a sort of smoother journey. So if you can imagine the general trajectory is up like that, and the broader equity index might be up way more, down way more, up way more, down way more. My aim, obviously it's still going to be volatile, but to get that smoother journey. I mean, it's pretty obvious. I don't know why I had to use my arm to show you what I meant by that. But yeah, we'll come onto the charts in a second and I'll talk you through exactly what's done what performance-wise. You can see that initially, I think this was a 30% allocation and I've increased it to 32.6. So any contributions that I've had, a lot of them have gone into Polar Capital Global Insurance. And that's because of the froth that I think we've got in markets, i.e. a lot of over-optimism. Like if you looked at a fear and greed index, it'd be at the greedy end. There's a good guy I follow on Twitter who I can't remember what his name is now, but something called, I think it's Warren Pies, and he works for a company called 314 Research, or he owns it. It's like a macro research type deal. And he published a chart today or yesterday showing levels of sentiment. So again, that greed and pessimism, or optimism and pessimism contrast, and we're at a level of extreme optimism at the moment, which is a sign that you should probably be more cautious when chucking cash at the market. I mean, it's one thing saying that, this can go on for months and years, but for me, I prefer to just stay more defensive in this sort of environment. And if we do get that sell-off, you might see me transitioning some of my defensive holdings into the more aggressive ones in BlackRock, US smaller companies, or the tech fund. I guess I can talk about this chart in the middle here. We are getting closer and closer to having a positive gain, which will make the chart way more smooth and way more like I intended it to look. you'll see when we come onto the charts that I started this series at the worst time possible. So this drop here was the tariff announcement, and that's pretty much where the series started. You can see within the first 4 weeks, I was down 700 quid, which wasn't ideal. But anyway, we'll come on to TrustNet, we'll come on to the charts now and talk a bit more about markets. Right, I'm going to start with a chart that makes me look clever, but it's sort of cheating, and I'm going to explain why. So what we've got on here is my portfolio in red versus the global equity sector in the blue, or the B line. And what that sector is basically made of is all of the passive funds, all of the ETFs, as well as all of the active funds, or actively managed global equity funds, trying to pick the best stocks, basically. And if I'd have had this portfolio for the last 5 years, then clearly I would have smashed it, which you'll come on to see hasn't been the case in recent times. But again, I think the point of this chart really, and if you were to zoom in on this upwards period, I would have underperformed. But on the downside there in 2022, I would have outperformed. So that's really what I'm trying to achieve in the long drawn out sort of bear markets, or in those downturns. I will look to try and outperform, and then if I give it back on the upside, that's fine by me, because we're trying to achieve that smoother journey. If we move into where since the portfolio series actually started, let's do it over 1 year. I know it's not exactly been a year, but you sort of get what I mean. I started the series up here. Yeah, perfect timing. And then we had the big tariff sell-off. You can see that I actually didn't protect better on the downside, and there's a couple of reasons for this. First is the small cap exposure. Small caps got absolutely smashed. Actually, let me show the constituent parts so we can see exactly what happened here. Right, sorry, I've just had to play around with this a little bit because the colours were all off. But now I think I've got it properly sorted out. So, as I described on the previous page, or previous dashboard, I guess, we've got 3 of each component. We've got defensive and we've got the more aggressive. So in this bottom sector here, you can see all of the more aggressive funds. They were absolutely smashed in the Trump tariff sell-off, and then the three more defensive funds performed really well on the downside. Absolutely smashed it on the downside, which is what I'd expect to see. The annoying thing is that healthcare, which is the F, which you can see here, has been targeted by Trump and his sort of cronies, if you like. You know, they are going after pharma, which has been a very negative thing for the healthcare sector and the sentiment there. So you've seen stock prices come off quite dramatically, which is why it hasn't had that rebound. But if you look on a 3-month basis, hopefully this won't change the colours and mess everything up. That relationship is completely reversed. So even with the US dollar headwinds, you can see those 3 more aggressive parts of the portfolio in tech, BlackRock, Global Equity Unconstrained, and Columbia Threadneedle American Smaller Companies are at the top, and then those other 3 defensive, or what are supposed to be more defensive, haven't really kept up with the rally. So that's what's happened since I started this series, and that's to be expected. What I did want to cover off was, if it will work, is the performance of my fund, my portfolio, versus the sector. So again, I've described what the sector is, and you can see that, yeah, for the most part, unfortunately, we were dragged down with the rest of the global sector at the start. I wouldn't normally expect that to be the case, but I think just due to the nature of exactly how that sell-off happened, in terms of the software businesses that lead the global sector, i.e. tech, were far less affected by tariffs than the smaller companies fund that I hold, and like healthcare, which not only is impacted by tariffs, but also being specifically targeted by Trump. But that said, what you can see is pretty much we kept up with the global sector, which is fine, until we've had this recent real burst in euphoria and burst in optimism. A good sort of signal for this is if unprofitable small cap index is outperforming the profitable small cap index, because then you've got a sort of a play on beta for the sake of beta, i.e. it's not about the underlying companies, it's not about profitability, it's not about anything like that. It's just it's called a trash rally, effectively. So garbage stocks rally far more than anything else, and that's exactly what you've got here, and that's what happens at points where you wouldn't ideally want to be investing more. Again, you've also got crypto popping off, which there are justifications for. I'm not completely anti-crypto in any sort of way, But when you've got crypto rallying as it is at the moment, and you've got this backdrop with NASDAQ and tech equities, it's just not an environment where, in my opinion, you want to be getting too aggressive. So that's what's happened. That's my take on markets at the moment. I think, I wouldn't be surprised to see a bit of a dollar rebound coming into the back half of the year, which would normally coincide with risk assets, i.e. stocks, selling off. So that's what I'd expect to see. That's what I'm sort of hoping to see, actually, because I've got a lot of US dollar exposure in my funds, and ideally I'd like to hedge that out if we get a bit of a dollar rally, as I've discussed in previous videos. But yeah, that's my take on markets. Make of it what you will. If you've got any comments or questions, let me know down below. Please leave a like and subscribe. And just before I end off, I just want to thank everyone for the recent views and subscriber growth and stuff like that. It's good to see, after a couple of months of being in the doldrums, that the channel is finally growing a bit. So yeah, appreciate you all, and see you in the next video.